How you can lose S-Corp tax benefits. Choosing to operate as an S-corporation offers significant tax advantages, primarily the pass-through nature that avoids double taxation on corporate profits. However, these benefits are contingent upon strict adherence to Internal Revenue Code requirements, and losing this status can lead to a costly reversion to C-corporation taxation. To help you protect your business, here is a detailed analysis of how an S-Corp can inadvertently or intentionally lose its tax advantages. The most common way an S-Corp loses its status is by exceeding the 100 shareholder limit. While this may seem like a high threshold for a small business, it can be crossed unexpectedly through inheritance, divorce settlements, or the issuance of shares to employees. It is important to remember that while certain family members are treated as a single shareholder, the IRS maintains a very strict cap to ensure the entity remains a small business corporation. If a 101st shareholder is added, the S-election is typically terminated immediately on that date. Monitoring your cap table and having a restrictive buy-sell agreement is essential to preventing this administrative oversight. Even if you stay under the 100 shareholder limit, bringing in an ineligible shareholder will trigger an automatic revocation of your S-Corp status. The IRS dictates that shareholders must be individuals who are U.S. citizens or resident aliens, certain estates, or specific types of trusts. This means that if a partnership, another corporation, or a non-resident alien acquires even a single share, the tax advantages disappear. This often happens when a business looks for venture capital or outside investment from other entities. Without careful vetting of every new investor's legal structure and residency, your pass-through status could be lost in an instant. Another critical risk involves the one class of stock rule, which requires all outstanding shares to have identical rights to distribution and liquidation proceeds. While you are allowed to have voting and non-voting shares, you cannot create preferred shares that give some owners priority in dividends. If the IRS determines that you have made disproportionate distributions, meaning one owner received more money per share than another, they may argue you have created a second class of stock. This often occurs when owners treat the business bank account like a personal fund without balancing the books. Once a second class of stock is deemed to exist, the S-election is invalidated. For businesses that were previously C corporations, the passive investment income limit is a major hurdle. If an S-Corp has accumulated earnings and profits from its C-Corp years and generates excessive passive income, like interest, dividends, or rents, for 3 consecutive years, it can lose its status. Specifically, if passive income exceeds 25% of gross receipts for that 3-year window, the S-election is terminated at the start of the 4th year. This rule is designed to prevent former C-Corp from using the S-Corp structure as a tax-sheltered investment vehicle rather than an active business. Keeping a close eye on the ratio of active versus passive revenue is vital for converted entities. A less discussed but equally dangerous risk is the failure to pay reasonable compensation to shareholder employees. S-Corp owners often try to minimize payroll taxes by taking a low salary and high distributions, but the IRS requires that you pay yourself a market-rate wage for the services you provide. If an audit reveals that your salary was unreasonably low, the IRS may recharacterize your distributions as wages. This doesn't just result in back taxes and penalties for Social Security and Medicare. In extreme cases of non-compliance, it can lead to a challenge of the entity's overall tax treatment. Ensuring your compensation matches industry standards protects the integrity of your tax structure. Finally, administrative and filing failures can lead to a loss of tax advantages, sometimes before the business even gets off the ground. The initial S-election requires filing Form 2553, and if this form is filed late or without the consent of 100% of the shareholders, the election may be deemed invalid. Furthermore, failing to file the annual Form 1120-S or neglecting to provide Schedule K-1s to shareholders can invite unwanted scrutiny and potential revocation. Additionally, more than 50% of shareholders can voluntarily vote to revoke the status if they feel a C-Corp structure is more beneficial. Staying diligent with paperwork is the final, crucial step in maintaining your tax-favored status. To learn more about our law firm's incorporation and corporate law legal practice, we welcome you to visit our website or contact our law firm to schedule an initial consultation. Thank you.